Credit risk analysis is very important for all the businesses, specifically for the businesses like banking and the business of non-banking finance companies. Let's understand the reasons why there is a need for credit risk analysis. Here, I have listed down the top reasons for credit risk analysis, and I will explain each of these in detail subsequently. The credit risk analysis is required because all businesses are required to exercise certain degree of prudence. Prudence would mean that you will manage your business in such a way that all the stakeholders are very well rewarded, specifically the owners, and the owner's wealth is maximized. GFC 2008 is an example where the prudence was not exercised by most of the bankers, and therefore they heavily invested in those assets that were not good assets, and therefore those banks went into liquidation and their investors suffered a lot. The second reason that gives rise to a need for credit risk analysis is the role of the central banker in an economy. The central banker is responsible for economic management, which means they should make sure that the monetary supply in the economy is controlled, the inflation is at a reasonable level, there is adequate money supply, interest rates are managed, and there are no job losses. Which means they have to make sure that the credit risk analysis is being done by the bankers in a prudent way, and the banks are not getting into wrong lending practices. Therefore, the central banker has to make sure that the credit risk analysis practices are very well followed everywhere. Credit risk analysis is very important to protect against the bankruptcies. Many businesses have gone bankrupt because their counterparties have not made the payment. Let's say you are in the business and you typically extend 3 months of credit to your customers. Now, if some of those customers don't pay you back, in that case your money is lost. But still you have to make payments to your vendors, to your employees, and to other stakeholders, which means you can even go bankrupt if most of your customers end up not paying you. So you have to be very careful about analyzing the credit worthiness of the customers that you are dealing with before extending credit to them. Credit risk analysis is important if you want to avoid the impact of heavy competition. The competitive pressure typically puts a lot of pressure on the pricing and the margins of the company, which means the profitability is low. It may also require you to give higher credit to the customers in order to grab the business. Now, let's say that competitive pressure increases a lot. In that case, you have to make sure that you are following the right credit analysis practices and not extending credit to the wrong customers, because those customers may not pay you and you will end up getting bankrupt. Credit risk analysis is also important specifically for bankers because they need to manage the overall impact of credit losses. In the business of banking, there is no escape from bad loans. Of course, how do you manage the bad loans? How do you make a better performing bank which has less non-performing assets? Requires you to have very good credit risk management and credit risk assessment practices. Proliferation of limited liabilities companies in the form of LLPs or limited liability partnerships and limited liability companies like private limited and public limited companies has given rise to a phenomena where you have access only to the company to the extent of the reserves and equity, and you have to stand in the queue to get your money back in case the company goes bankrupt, which means you have to be very careful in extending the loans to limited liability companies. So it requires a very good credit risk analysis. Because of the internationalization of the markets and the impact on individual markets of international economic performance, the asset prices fluctuate more wildly. Hence, it is important that you manage your collaterals very well. If the borrower has given you, for example, gold as a security against the borrowing, in that case you have to monitor the value of gold very carefully to make sure that your overall exposure is not more than the value of gold which has been given as the collateral. So managing the collateral, their prices, tracking those prices is very important if you want to assess your credit risk and manage it properly. It is very important that you manage your asset quality very well. Specifically in banks, at least about 60 to 70% of their asset side is comprising of their lending, whereas the rest 20 to 30% could be investment in various securities. Now that 60 to 70% is at a very high risk because those are borrowers. Now you have to make sure that you have very good credit risk assessment practices in place to make sure that you don't have too much of NPAs or non-performing assets. So you have to monitor these NPAs at gross non-performing assets level, net non-performing asset level, and you have to also see that you are following the prudential income recognition lines when it comes to the non-performing assets. You need to have a very good credit risk assessment practice because you have to price your credit risk accordingly. What is pricing of a credit risk? Typically, the interest rate that the bank charges to the customer depends on the level of credit that the bank pursues. The customer who has a higher risk is typically charged more interest by the bank. Likewise, the best customers, what are called AAA customers, are charged less interest. So, for pricing the credit risk, you need to have very good credit risk analysis practice in place. You need to have proper credit risk analysis practice in place to analyze and track the off-balance sheet items that are involved while assessing the financial performance of your borrowers. These off-balance sheet items include various things. For example, there could be a legal claim against a company which might materialize and the company has to pay out a huge amount. The company could have taken, let's say, assets on lease, and those assets are not visible on the company's balance sheet. Of course, there are leasing accounting standards that now require the company to disclose the assets which are taken on lease. So to carefully go and analyze the impact of those leased assets. Your borrowing could be engaging into a lot of business transactions with the holding companies, subsidiaries, group and associate companies, and you have to carefully understand the impact of all those transactions within the group. The companies nowadays very frequently use derivatives to manage their risk. But that can also lead to another kind of a risk, because if derivatives are not properly managed, then they are also a risk. The company could have used factoring where the bank has a recourse back to the company. The company could have discounted bills with recourse. So those are hidden items of liability that the banker should be aware about. So your credit risk assessment practices have to be very, very robust. I hope with this you have understood different factors that lead to the need for credit risk analysis. If you have liked this video, please do subscribe to my channel and also share this with the friends who will benefit from this. Thank you very much. Cheers.